Hello and welcome to another episode of Macro Mondays. My name's James Brodie. I'm Head of Learning Development here at Flux Institute.
I'm James Todd, Trader Performance Manager here at Onyx Commodities.
And I'm Will Cunliffe, a Research Analyst here at Flux.
Plenty of charts, risks and trends to discuss this week. Firstly, news out over the weekend, again, that Donald Trump is pledging $2,000 stimulus to over 85% of the population. That's certainly supporting gold and equities this morning. We're also close to the end of the government shutdown. It looks like the end of that is nearing. US layoffs are surging. There's bad economic data, and also University of Michigan consumer confidence in the United States is now the second lowest levels ever. Looking at equities, we'll discuss the fact that earnings are growing at the fastest pace in 4 years. That will support, of course, equities. At the same time, last week, Michael Burry started to go aggressively short of particularly Palantir and NVIDIA. So we're seeing much more volatility and a more aggressive sell-off last week in the AI stocks. So let's start with the news of Donald Trump announcing a tariff dividend up to $2,000 for up to 85% of Americans. Again, this is going to be inflationary. It's going to be more of a debt burden. It will put the Federal Reserve into more of a quandary. Inflation versus should they be cutting rates? This morning, gold is up 2%. Equities, the NASDAQ's up 1.2%. Yields are up 5 basis points and the dollar is down. As Paul Tudor Jones has said, all roads lead to inflation. And you can see the gold chart here. That's a clear fall from the peak. It's gone sideways and it's ticking up.
Yeah, it's an interesting idea. My question is obviously going to be, what will the pass-through of this $2,000, if it were actually to be enacted and handed out to 85% of the population, what would the pass-through of that be on, US-produced manufactured goods, the sort of key areas that Trump is trying to target with the tariffs overall? Ultimately, if you're seeing demand substitution from cheaper imports to more expensive domestic supply, having a $2,000 windfall is probably going to be, in theory, in a purely economic scenario, quite good for that domestic demand. But in reality, I think a lot of people might look at that and think, well, equities keep going up. Maybe I can pass, my $2,000 just into a one-time purchase in, the S&P ETFs and that sort of thing. I think it's no surprise to my mind that we have seen equities up and gold up off the back of that, rather than because of an underlying belief in the US economy. Do you see equities going up more? Well, there are going to be more buyers than sellers for a little bit. And yeah, it's going to be interesting to see whether this $2,000 tariff dividend does actually happen. I was looking at Polymarket this morning, and yeah, over the weekend, the odds of a 2025 tariff dividend jumped from about a 5-6% chance to over 20% chance. It's still quite volatile, but yeah, I don't think there's a clear conclusion that Trump definitely will do this, especially within 2025. So it might be a case of buying the headline rather than buying the actual truth.
Yeah, for sure. I mean, I would probably second that I think it's going to be pretty challenging for him to actually implement it. He says that it will be funded by tariffs. If you look at kind of data from the Treasury, tariffs have yielded about $195 billion worth of tax revenue during the fiscal year 2025. About $30 billion a month now at the kind of the higher tariff levels. But this package would cost in the region of $600 billion. So that's a pretty big shortfall that's going to have to be funded through issuance. And, part of the reason we are in this US government shutdown is because fiscal strategy is not something that the government is able to productively debate. And both sides of the discourse are still remaining gridlock. It looks like they might be able to sort stuff out, but it's still tenuous, and there's still a lot to be worked out on the kind of fiscal side.
And call me a cynic, but last week Donald Trump did particularly badly in the elections, and his ratings are falling. So clearly this is trying to support his ratings somewhat.
Yeah.
And the other point is, it's another example of how he's making it extremely difficult to trade markets because he comes out with these either just Twitter headlines or just false promises.
Yeah, definitely. And I mean, to me, it screams, COVID stimulus, just kind of throw money at a problem. And funnily enough, 2 years down the road, you've got pretty persistent non-transitory inflation that the Fed is going to have to deal with.
And one thing clearly is the winner is gold again. The gold trade is back on, as we can see from the chart. You can see it's clearly breaking higher again. Clear levels to have a stop loss as well, just below 4,000. Again, the market will be jumping on that trade, especially the shorts that were getting extremely nervous by the sell-off. If we move on to US layoffs, the Challenger Gray announcements last week. US base employees announced 153,000 job cuts in October, the highest for any October since 2003, even including financial crisis and COVID. And there's been over 1 million layoffs announced to date. So although we don't have the official government data coming out for payrolls, you can see that there's clearly weakness in the market. Clearly the Fed will be focusing on this. But again, if there's going to be a stimulus package, that just throws more, what's the word? What do the Fed do? You've got inflation on one side, weaker data on the other, more unknowns, and Donald Trump trying to get them to cut aggressively.
Yeah, and I mean, if we look at recent history, Powell's response to that kind of tension in the dual mandate has been to wait and see. So, I mean, I think the market is looking for the Fed to cut. I think at the moment they're pricing as if they want the Fed to cut. And I think this will obviously fuel the fire. I think the market's also having to adapt with the lack of national data, with the lack of data from the BLS. We don't have payrolls that we can look at. Perhaps that's a good thing, given the amount of revisions there have been in recent years.
It's woefully inaccurate.
Yeah. That has been a long time criticism of the likes of the ADPs or Challengers, is that they vary massively from the payrolls. But if payrolls are constantly revised, then maybe it's a good thing that the market's shifting its focus. But it's concerning for sure as to where that puts the path of the Fed funds rate. I wouldn't be surprised if we're holding a little bit longer.
Also, if unemployment is going to creep up, this is bad news for Treasury Secretary Bessent, because they're trying to inflate and grow their way out of debt, and clearly this is all bad news.
It's also, it's why I think it's always good to have multiple sources of data to help you get an accurate picture of how things are. Because I saw another chart similarly saying, job openings are at all-time lows. And whilst job openings at all-time lows, you can sort of think, okay, well, that's not necessarily going to be bullish. To some extent, you can see job openings drop when capacity is full and people are, going at full berth. Whereas with this, you can see that job openings are low and sackings are high. So you've got a clear, you've got A plus B equaling C here. You've got low job openings, you've got high sackings, so you are going to see unemployment pass through. It's not a question of if one, the other. The two combining makes it quite clear what's going on.
And one thing I don't see governments discussing is the impact of AI on jobs. I mean, Bernie Sanders came out and he talked about 100 million job losses over the next 10 years is pretty extreme one way.
Yeah.
But AI will have an impact on jobs for sure.
Definitely. I think that's going to be most pronounced in the likes of the Indian economy. So if you look at service sectors broadly in the West, they've already kind of extradited a lot of those more manual, menial jobs to India and places like that. Now, those are the first jobs I think that are going to be hit by AI. So yeah, if I was India, I'd be looking at that pretty closely.
Yep. If we move on now to US consumer sentiment, it fell to 50.3 in October. You can see from the chart here, that's the second lowest reading ever. Now, Donald Trump, not to pick on him, but he says it's a great economy, and equities are at high levels, which is good for equity holders. That's normally a sign of confidence, but clearly confidence is low here. More bad news for the economy, more bad news for Donald Trump. And the Fed have to look at this.
Yeah, I'm not surprised that consumer confidence is low. Especially considering how chronically online a lot of the US population are, etc. Like, I spend my time on Twitter and X or whatever, and I just see bad headline after bad headline after bad headline. So of course that will get passed through. And as you're seeing more and more unemployment, less security over people's jobs in the future, it's not surprising to me at all that we're seeing consumer confidence falling off a cliff.
A good point on what you say there. Do you think actually social media polarizes views even more? So that's why we have a worse reading now?
Yeah, I'm certain that it does. There are a lot of things that, like we talk about equities, the fundamental landscape of the equities market has changed over the past 30 years because the ease and accessibility of retail to go and sort of buy means that historic facts and figures, whilst they hold some non-zero value, they're not necessarily the best forecaster of future equity prices. Similarly, in terms of public opinion, even if you look back at the 2016 Cambridge Analytica stuff, in a US election, you saw something that had never been done before because of the social media craze. Yep. I think it would be naive to think that hasn't, been exacerbated and continued further over the previous 9 years. So we live in a world where social media really does dictate a lot of people's moods and opinions on a day-to-day basis.
Definitely. And I think, a lot of people are attributing the kind of rally in broader US equities to kind of flow story, right? So retail will just buy and hold. Instead of savings going into sort of, in the UK, we have a cash ISA. People are putting it in their stocks and shares ISA or their 401k, they're allocating to equities. Now that was true during COVID, they did hold, but consumer sentiment, as you can see, was quite a lot higher there. So I wonder if kind of we're reaching those levels now where maybe retail will start to pull out of equities, and that flow might reverse. And as we've discussed before, that's a pretty leveraged position, which if it unwinds could be pretty aggressive.
And that would push consumer confidence lower,
exactly,
along with job losses going
and it becomes a kind of snowball effect, almost self-fulfilling.
Okay, let's move on to equities. As we say, I've been fairly bearish talking about equities, and the fact that we looked at retail traders have been adding over the last few months, hedge funds have been going short. But US earnings are growing at the fastest pace in 4 years. That will definitely support stocks. Here you can see data from the FT. But if we go on to the next chart, you can see the NASDAQ here. So the NASDAQ, that would be typically seen, that's a rising wedge pattern. Typically when it breaks, you'd start to get an aggressive sell-off. Short-term moving averages started to roll over, but on Friday we did get a bounce, and we're going to get a bounce today. It's already up 1.2% over this potential added stimulus. But why is to my view, that means what we're seeing more volatility, and again, Michael Burry selling, looking at buying puts, so going short of the big AI stocks. To me, this would see a rotation out of the AI and the tech back into the more Russell 2000 and the S&P stocks. If we go on to AI data center borrowings exploded in September, raising debt and power concerns. Sam Altman came out last week saying he wanted the US government to backstop their over $1 trillion of potential investment, which I don't think the taxpayers can be too excited about. And over the weekend, the CEO of Microsoft says they have thousands of GPUs that are sitting idle because they simply haven't got the power to run them. Yeah,
I mean, Microsoft, I think in one of their, maybe an internal memo that was circulated about data centers, said that, looking at 2028, 2029, it is going to be impossible to overinvest in these data centers, indicating how fundamental they see these data centers in being, to their future business and I suppose the future of the AI world. It seems absolutely crazy. I think I don't see it as sustainable, but I also am not an expert in the field. I mean, it's as pure and simple as that. It's entirely different, and the sheer strain on like a national grid that data centers will be by 2030. You're looking at OpenAI projected to have more power demand than the UK by 2030, which doesn't seem sustainable to me.
And you're already seeing in states with data centers the cost of electricity going up, which is going to be inflationary. But surely now the smart money is to move out of AI and into power generation stocks.
Yeah, I mean, I suppose it's derived demand in that sense. But if you do have, a fundamental buyer perennially, then you're going to be well to be operating in that space.
If we move on, we mentioned Michael Burry, famous for his role in The Big Short. He's actually always looking to short markets. He typically goes in too early, but he announced last week he's gone aggressively into shorting with puts, particularly Palantir and NVIDIA. Apparently he's put 80% of his worth of his fund, $1.4 billion into this. Again, it's not that much risk he's risking because he's in there via options. But we've seen Microsoft fall nearly 11% in the last 8 days, NVIDIA fall 12% in 4 days, Palantir falling 16% in 4 days, and Meta falling nearly 19% in 7 days. So these stocks that have had all the huge flows, these big AI stocks, the Magnificent Seven, are now certainly seeing some volatility and struggling.
Yeah, the classic quip about Michael Burry is he's successfully called 17 of the past two recessions. Yeah. So, he's a perma bear. And to some extent, the market doesn't always adhere to his positions and go the same way as him. But one of the things to note, especially in the past week, is he does, a trick that I suppose Musk has done a few times. And if you look at the US senators, they seem to always pull this rabbit out of the hat. He goes on Twitter, or he goes on X, and he mentioned something about a bubble just after having put on a massive short position. And a lot of speculators look at that and they look at what he's saying, and so they either take length off or they actively get short. So it becomes a bit of a self-fulfilling prophecy. I think ultimately a lot of the softening in these Mag 7 companies, part of it will just be a knee-jerk reaction to that. So it wouldn't necessarily signal a wider realization in the sort of trading zeitgeist that everything's a bubble and it's overdone. But these are the sort of cracks that do appear every now and then. And yeah, ultimately, because everything is so overextended in equities, when this goes, it will go really fast. And the fact that we've seen, Palantir off 16% in 4 days, that's a sign that we are, I suspect that this will go, and yeah, it will be very sudden when it does.
And there's a huge amount of leverage and there's a huge amount of retail, and that would hit consumer confidence even more, which hits retail spending. Yep. It's a knock-on effect. If we actually look at the chart here, Palantir against other S&P stocks, you can see it's recently traded over 240 times forward earnings. You can see where it stands out, forward price to sales ratio and forward price to earnings. It's a clear standout here. Highest valuation for company of its size, 491 billion in history. And if we move on to the next chart, you can see the actual chart of Palantir. Actually, it's had a sell-off, but you can see where it's come from. It looks to me like the trend is still upwards. Support, you can see the white line. To me, I would say that's the first real line of support, $173. It's holding above that. The next level of support will be $147. To me, that's still an uptrend for now.
Don't disagree. Yeah, I mean, it is, ultimately quite a volatile stock as well, which will mean that if you're looking at having scale in, similar to what we're going to be talking about with Bitcoin here, but if you're someone that missed, 147 before, you're probably going to be putting a buy order in at 147. And similarly, scale back buying at like 120, yada, yada, yada. So you will see scale in buying at these sort of key sticky levels. And as a result, yeah, it will face resistance when going down.
Support. I would say also,
as in when the equity is coming off, it's going to face resistance there. So it will sort of bounce off these sticky lower levels.
I would also say below those key levels, you would see some stop losses as well.
Yeah.
But I agree, right now it seems to be still an uptrend. Moving on, commercial mortgage-backed security delinquency rate jumps to 11.7%, the highest level in history. It seems to be saying I'm talking about just bad news here. I mean, where's the good news? Where is the good news?
Arsenal top of the Premier League.
Okay.
This chart is clearly quite concerning. I think people have been concerned about commercial real estate for a while now, so this is not going to be coming as good news. I do think there's an element here that obviously we've been in a kind of higher for longer scenario at the Fed, which has been elevating mortgage rates, and an element of that will kind of increase delinquency. But hopefully we're going to get a cut in December, which should alleviate some concerns. There's also been tightness in broader liquidity markets, so in overnight repos have been drawn on a lot. So that should be alleviated.
Having said that, the cut's 16 basis points price, so it's nearly 50-50. So we have, I think, 9 Fed speakers speaking this week. They haven't got much data to go on, so it'll be interesting to see how that plays out, if the Fed try and steer that.
Yeah.
But a fair point, commercial mortgage-backed securities don't have a big impact on the wider economy. Does have an impact on the banks, though. The banks have a lot invested here. So maybe the warning signal will be if bank stocks start to fall, particularly regional banks, where we've seen some stresses already.
Yeah.
Moving on to bonds and interest rates. We just started to discuss it there. This is the US 2-year yield. You can see clearly the lows from COVID. You can see here we have a clear support now at 3.4%. I kept saying I'm expecting this to go lower because of the economic data is appearing weaker, the data we're getting, the layoffs, unemployment going up. But now, if there's going to be more stimulus, you might see the market start to look towards two things. Firstly, inflation, so the Fed are less likely to cut. Secondly, people saying, well, we don't want to be holding bonds if debt's become an issue. They would more move down to the far end of the curve, but yields across the curve are up 5 basis points today. To me, if I had to put a trade on here, I'd sit on my hands and do nothing and wait to see which way it breaks.
I think that's, ultimately a good decision here, because especially at the moment when everything is hypothetical, talking about stimulus, we've seen Trump, chickening out time after time on these things. He will tweet something and then he'll renege on it. So this idea of, well, it might break to the upside if we see stimulus and inflation and see the Fed less likely to cut as a result. We're sort of like dealing in 4 separate orders of conditionals. Yep. So I think you just got to wait and see. And if you're making, if you're putting a trade on, if you were buying this for that logic, you should only be doing that if you have an edge that the rest of the market doesn't sort of really value correctly, i.e. you are certain that there is going to be inflation coming from this stimulus and you have an advantage over the market in that sense. Being in a position like mine, and I assume yours, where we are just sort of observing and aren't particularly close friends with Donald J. Trump, just sit and watch. And
yeah, I wish I had some inside information. Unfortunately, we're not that close yet.
No,
not yet.
A trade I do like on that, looking at yields, the US 2s 10s curve. You can see the next chart here. You can see we had the big sell-off. The market was in negative. The 2s 10s was inverted for a long time. We had a double bottom. It's rallied. We're currently at 53 basis points. It's gone sideways range for a long time now. What's that? Over 6 months. The range we're in, the upper range there is 61 basis points. The lower range is, 64 and 41. So this is the curve steepness, the 10-year minus the 2-year. If we start to see more concerns about US debt, and 6 months ago, that was a big story. Yeah. It's gone off, it's gone secondary with weaker data and gold. Mm-hmm. If that comes back, then I expect the curve to steepen because it will be the long end that people don't want to hold.
Definitely. I mean, that's what we saw. That's what we saw last time. Even though the Treasury had front-loaded a lot of the issuance, we still saw that kind of shift of liquidity down to the front of the curve. I think there's going to be a couple of things that would also aid that. If we perceive the Fed to be a little bit softer on inflation, not quite so focused on that 2% target, because at the moment inflation is around 3% and they seem to be happy to cut. If they're perceived to be a little bit softer, then we could see break-evens rally at the back as well. And then if Trump is expected to be more loose fiscally, then that could also boost growth expectations down the back of the curve. But yeah, it seems like we're stuck in a range for now. I had expected this to go steeper earlier, but it seems to be pretty stuck.
Yeah, the other point, there's a long end, but also the front of the curve. Do the Fed, do they or don't they in December? Say it's 16 basis points priced. The market's, 50-50.
Yeah.
Pretty much. Moving on to the UK 2-year yield, you can see there's a similar support line coming in there at 375. And we don't have any stimulus coming out of the UK. I very much doubt the budget Rachel Reeves will be giving a £2,000 stimulus to everybody. I can hope, but it's not going to happen. We're going to get tax hikes instead. And pay-as-you-go driving charges for electric vehicle drivers and all sorts of others, perhaps even a mansion house tax.
Changes to national insurance, changes to ISA contributions. I think a lot of people, it's hard to know exactly what she will do, because she does sometimes almost Trojan horse a softer landing by, the last major budget. It was softer than people had.
There was rumours of huge capital gains tax hikes, and then they came out a little bit softer. Yeah.
Clearly here, they're giving out all the potentials, all the possible bad news. So when we get it, it won't be as bad.
Yeah.
It's not going to be good, though.
I would think it unlikely.
And let's move on to Brent.
Yeah, I mean, you want to take us?
Yeah, so I mean, we've been kind of consolidating, drifting towards that kind of $60 handle over the past week or so.
Sorry to interrupt you. This is just say a long-term chart here. This is a 5-year chart.
Yeah, and I think there's a lot kind of driving flat price Brent price action. We've had obviously sanctions drive concerns of like trade rerouting, especially regarding India. Are they going to keep lifting Russian barrels, or are they going to have to go to PG to kind of rotate their feedstock? There's a little bit of a scramble, but that seemed to have been dissipated. We saw them offering PG grades back again. So that it doesn't seem like the market's scrambling for barrels right now, especially on the time spreads. We've seen them soften dramatically. So front spread in Brent is now at like 20 cents. And I think the market still seems concerned about oversupply, and everyone still seems concerned about these bearish balances. But then at the same time, we've got like refinery margins are at yearly highs, especially in Asia and Europe. We've got really strong margins. We've had a bit of refinery outage kind of across Europe and Asia. Dangote's RFCC is down and their CDU is down. That won't surprise many people, but that's been constructive in the product cracks. We are yet to see refinery utilization tick up off the back of that, but that should pass through with time. I mean, there's a lot of spare capacity, especially in China. I think Shandong are running at about 55% utilization.
But a lot of refineries are in maintenance as well at the moment, aren't they? So that's a typical seasonal pattern you see where they go offline for this part of the year. And so if a refinery is not purchasing crude, you see less sort of upward support.
Exactly.
To my mind, the major story in crude is just still about, like, yes, oversupply to the downside, but that headline last week about the sanctions on Russian barrels, and particularly the sort of parties purchasing from Litasco, Lukoil, sorry.
Yeah. Rosneft,
Yeah, what amazes me looking at this chart, away from the fundamentals, is just we've been in such a narrow range for 3 years now. We've seen gold surging, we've seen other commodities, copper surging, but this has gone sideways. Tough one to trade. And we had a few of the big trading companies talking about next year's prices, and they're all anticipating it in the 50s, aren't they?
Yeah, I mean, I think the consensus is pretty bearish. I think a lot of that is to do with the kind of anticipation of unwind from OPEC. But I mean, if we look at the most recent set of OSPs, official selling prices from Saudi Aramco, they were pretty firm. Like, market structures had implied a cut of about $1.60 for Arab light into Asia. Instead, we got $1.20. So that's kind of indicative, at least in my mind, that there is still firm demand from Asia. They can still charge a little bit more than structures imply. And that also suggests that they're not just going to release the taps and start pumping more. Because typically, if they were to do that, they'd need to make space in the market by offering a slightly cheaper price. So yeah, it's a confusing one at the moment, I think, for a lot of participants, but yeah.
I like the fact when I mentioned predictions, Todd, you pull a face. The value of predictions is close to zero, isn't it? Because we have all these predictions where S&P will be at year end. they mean absolutely nothing. I don't even know I'm having dinner tonight, let alone predicting the future. The only thing that matters at the end of the day is the price. Moving on to currencies, the dollar index, you can see here it's stalled at key level. It looked like the dollar was getting stronger. It was. There was a clear double bottom around 96 level. We can use with a more potential stimulus coming out. And if we look at that on the next chart, the dollar yen, here you can see a clear trend line support, clear resistance. We're up at the top end of resistance. In theory, this should go down if the Fed are cutting, the Bank of Japan are raising rates. But now again, it looks like it's a straight dollar trade. Is it going to go up on inflation or weaker on US data? But clearly, again, a good one to trade. Trend lines like this, there will be stops just above the upper resistance. There will be stops just below support. And to be honest, I'd wait and trade the break. And the last currency, the pound, you can see on the next chart, the pound sold off pretty aggressively the last few weeks. It's broken key support levels. It's come back to retest it. To me, it would be interesting to see if the short-term trend, the downtrend, continues from here. You can see where the clear resistance is, but the pound's looking weaker than the dollar.
Yeah, and I'm not sure. As and when Rachel Reeves comes out with her budget, I'm not sure we're going to be seeing the pound strengthening at all much there. I wouldn't be surprised if we see that downward trajectory.
Although that being said, I think a lot of the kind of the talk about fiscal restraint and hiking taxes has driven flight to gilts, and gilts have benefited quite a lot from all of this rhetoric. And if we see a kind of a pair back in their pro-tax agenda, we may see a bit of selling in the gilts, which could aid the pound on an interest rate differential basis.
Yep, interesting. Onto Bitcoin. Bitcoin, you can see it's bounced off key support there, right on $100,000. Round numbers tend to be key good support and resistance levels. It looks to me it's been going sideways literally for the last year, a small up bias. But again, if this closes below 100,000, then that would be pretty bearish, I'd say. Any view here?
Yeah, I think my point earlier in the show just about people scaling in order to reduce volatility. If you're on one of your dealing apps, you will most likely be given the opportunity to, purchase at a level as and when it hits it. So you will just see stickiness around these $100,000 or these sort of quite nice psychological levels. And I think Bitcoin, much like FX, you see so many things on YouTube saying, "Oh, learn how to trade with me," and people pay a lot of attention to key levels and also to the nature of charts ultimately in both FX and crypto. So yeah, I wouldn't be surprised if you do see proper support here.
One chart I didn't put in, actually, I meant to. The correlation between the NASDAQ and the Bitcoin for the last year and a half has been really close. It's broken down, though, in the last couple of months with NASDAQ going higher, Bitcoin breaking lower. That would concern me, actually, if I was a crypto long.
Yeah, I think, a lot of the kind of retracement there's been a huge amount of kind of whale wallet liquidations. So we've seen some big players liquidate a lot of their Bitcoin, which has contributed to that aggressive move down. And you can't write off that not happening again. It's one of those, a lot of Bitcoin is concentrated in a few wallets because it's had such an aggressive move up. So there's a lot of Bitcoin to be liquidated still.
Excellent. And on to the OIS, what the market's pricing for central bank movements over the next 12 months. The Fed, we mentioned 16 basis points of cuts priced for the next meeting. Not far off 12.5, 50-50. But there's just over 3 hikes priced over the next year, which is just 10 basis points from the ECB. Again, I think that's a bit lean. But what that has is the base rate in a year's time. The US, it has it at 3.1%, at 1.83 for the ECB. But again, if we get more signs of weak inflation in the ECB, I see them cutting more aggressively, even talk potential deflation next year. Another standout there, RBA, just 16 points of cuts priced. RBNZ 31. That has the terminal rates in Australia of 3.44%, in New Zealand at 2.19. That would have Aussie rates well over 1% above New Zealand. Historically, New Zealand's always been much higher. But again, they didn't hike rates as quickly. They had a huge housing bubble, and now the housing bubble actually is falling. One of the fastest countries it's falling in is New Zealand. So they are cutting rates particularly hard there. The Bank of Japan, 49 basis points of cuts priced over the next year.
Hikes.
Yep, sorry. That should be supportive of the yen, but of course, with the debt they have, the market's pretty nervous about touching that. Data for the next week, or this week. Coming Tuesday, we have the UK British Retail Consortium's retail sales. We also have UK employment data tomorrow. German ZEW, US ADP we will get, and National Federation of Independent Businesses Small Business Index. Wednesday, German inflation and the OPEC monthly report. Thursday, UK GDP, UK industrial production and Australian employment. On Friday, French inflation, US PPI we should be getting, even if the government is still in shutdown. And we also have 9 Fed speakers this week. Just before we go, just to remind you, we do now have some online training. We have trading with discipline, looking at technical analysis, fundamental analysis, and behavioral finance. This week, we also have a training course from gas, trading gas going live. In the next couple of weeks, we'll have trader psychology from our Formula One psychologist, Chris Gooder. And we also have the first full week of January, the 5th to the 9th. We have internal training for our traders. You can also join that. We have discounts online. Take a look at that. You can also email us for that. We had some internal training last week with new traders, and we had some external clients joining us for that. Do take a look, and we look forward to joining you next week. Thank you very much.
Thank you.
Thank you.
Hi everyone, I'm James Brodie, Head of Learning and Development here at Onyx Capital Group, and I'm delighted to welcome you to this immersive course on commodities and financial markets called Trading with Discipline, where we take a deep look into fundamental analysis, technical analysis, behavioural finance and risk management, all based on our one-day accredited programme with the Singapore Institute of Banking and Finance. Across a series of webinars, we'll explore the fundamentals of global markets, starting with an introduction to commodities and energy trading, before moving into key drivers of market prices through fundamental analysis. We'll also provide a clear overview of bonds, equities, and foreign exchange markets, ensuring you have a strong cross-asset understanding. We'll then dive into technical analysis, including trend following, mean reversion, risk management, and program trading strategies. We'll also examine the increasingly vital role of behavioral finance, helping you understand trader psychology and emotional discipline in real-world trading. The course includes interactive trading simulations powered by Amplify Me, multiple choice review tests throughout, a final end of course exam, and a certificate of completion. This program is ideal for anyone looking to develop a deeper understanding of financial markets, sharpen their trading instincts, and build real practical skills for the industry. I look forward to seeing you on the course.